National Stock Exchange of India has been actively involved with initiatives to educate the young generation of our country on the importance of financial management. One such initiative is NSE FinWiz that focuses on educating and advising the young workforce of the country on wealth management to enhance financial literacy and to empower
Insurance is for protection and investment is for growth.
Another program facilitated by NSE IPFT is NSE Financial Quest. This inter-school financial quiz contest goes an extra mile by educating the young students on fundamentals of finance.
What is this? It's the formula for the simple interest.
Simple interest is the right answer.
Under the NSE Financial Quest Base Camps banner, the program engages students around the year through workshops on various topics, projects, interactive videos and quizzes.
DiCaprio is bouncing checks of Pan Am.
Plus 75 on that. Plus 75.
To facilitate these two programs, NSE along with CNBC TV18 has travelled across the country to bridge the wide knowledge gap in terms of finance. In this episode of NSE FinWiz, we are all set to achieve our objectives once again by gauging young professionals in a new city.
The National Aluminium Company Limited, also known as NALCO, is one of India's largest aluminium refining, smelting and casting companies. It was established on 7th Jan 1981 with its registered office at Bhubaneswar and has integrated and diversified operations in mining, metals and power. The main units of NALCO are at Damanjori and Angul. NSE FinWiz visited the Angul plant of NALCO along with the experts to gauge the thoughts and notions of its employees on wealth management and financial planning with the theme Dreams Come True.
Personally, I have not been very friendly with the equity market. I don't have much knowledge about the equity market. So we have been trying to, do something through mutual investment and all those things. But in long term, yes, in the long term, we would like to have something, because at the age of superannuation, at the age of 60 when we superannuate, I would like to have some investment in such a way that it gives me a comfortable living scope for all the another 20-25 years.
I have invested some money in fixed deposits and MIP and SIP also I have invested. And long-term planning, because I am about 7 to 8 years to retire. So I could not do long-term because the opportunity was not available to me.
So short-term is for going for a foreign trip holiday or some organizing social functions. And for long-term child education, marriage and buying a house property. And mostly retirement planning also.
Hello and welcome to Season 4 of NSE FinWiz, powered by CNBC TV18. And I'm your host, Nitya Balakrishnan. Today my team and I have travelled deep into the interior of Odisha to the training institutes of one of India's jewels in the mining sector. We're at NALCO in Angul. And I'm in conversation with Pankaj Matpal and Mehrab Irani. Thank you so much for joining us here this evening. My first question to you, Mr. Irani, is when you talk about multiplying your wealth, what is the first thing that comes to mind? How early should it be and how should you go about it in a planned manner?
I think planning is very important. We have to set our goals, and the more early we start, the more it is beneficial. I'll give just a simple example. Say if a 25-year-old young person, if he starts planning today and say if he saves for next 30 years, then say if he saves 10,000 rupees per month or 1,20,000 rupees per annum, then at a 12% investment income, it will amount to almost 3 crore rupees after 30 years. But if he delays by just 5 years, then he will have to almost save double the income.
Sure.
He will have to save 20,000 or 2,40,000 per annum to get that same 3 crores after 25 years from them. So therefore, it's very important to plan early and start early. Also, I think we'll have to set proper financial goals. I think everybody has goals in life, and as far as finances are concerned, there will be 3 main kind of goals. One would be the short-term goals. Those will be like within next 1 to 2 years, like your education or something like that. The other would be the medium-term goals, which will be like between 2 to 5 years. Those will be like say your marriage or buying some kind of a small house or a car or something like that. And other would be your long-term goals, say 8 to 10 years or more. Those will be your retirement, your children's marriage, education, and such kind of long-term goals. So I think we have to make proper financial plan for each set of goals in our life, and we have to start early. That is the main mantra of investments.
Absolutely. If you've started earning today, start investing today, pretty much sums up what you've said. In fact, let's have a quick show of hands. How many of us here actually set aside a specific amount every month towards saving or investment? How many of us here invest into something called the equity markets through various routes, whether ELSS, SIP, directly into the equity markets, mutual funds? And any investors in the yellow metal or gold? Mr. Matpal, I'd like you to jump in here. Traditionally, the Indian investor thinks of typical ways of setting aside money. NPS, savings bank, fixed deposit. But what are the options that are out there today? And especially when you throw light on the equity markets, what will you answer to this question of, is it too risky or volatile?
See, most important thing is asset allocation. You should invest in different asset classes, and mainly we have equity, debt, commodity, where we invest mostly in gold or silver, and then we have real estate. So if you should invest in all 4 asset classes based on your financial goals. If you are investing for long term, then definitely equity should be in higher allocation, because we have always seen that equity has delivered better return compared to other asset classes in long term. But if your goals are very short term, then your higher allocation should be in debt instruments like bonds, debentures, or mutual funds which invest in bonds, debentures, etc. Then gold, yes, though you cannot expect very good returns from gold, but to just give stability to your portfolio, you should have some allocation. 5 to 10% of a portfolio should be allocated to gold. Real estate, though you can expect reasonable returns from real estate in long term, but it needs a lot of money. So you cannot start investing 2,000, 1,000 rupees in real estate. Yes, through SIP in mutual fund, you can invest in equity, you can invest in gold, you can invest in debt market, and when you create wealth, with that you can invest in real estate as well. So 2 things are very, very important. One is asset allocation, and second thing is start early, save regularly. As soon as you start it, because of power of compounding, it is easier to create wealth.
Absolutely. Fair enough. But if I were to talk now about tax saving, Mr. Irani, that's something that all of us have internalized, because it's definitely part of that payslip. You look at, how am I going to set aside exemptions under ETC, ATD, etc. Given that, talk to us about ELSS as one of the probable vehicles of investment.
Yeah, I think ELSS is one of the best methods for saving tax because number one, you can invest in equities through that. So it gives you growth assets through ELSS. Plus also the time period in ELSS is the minimum. That is a 3-year lock-in period. Though we advise for investment of much, much longer time, but the time period again is lowest. You get the benefit of investing in equities and compounding also. So I think ELSS compared to what the other things are there, it gives one of the best investment options. Yes, there is insurance also, and that is also an important component which we'll discuss just now. But compared to bank FDs and other things, I think ELSS is one of the best options which is available under ETC.
Fair enough. Mr. Matpal, if I can ask you, equity markets, real estate, gold, rank in the order of preference, what would it be?
Definitely equity, first choice of investment. But yes, your objective of investment, risk appetite and time horizon you have to keep in mind. But if your time horizon is reasonably long, say 5 years and above, then equity should be allocated in higher percentage, then followed by debt instruments, and then last will be gold.
Now, before we slip into a quick break, Mr. Irani, if I can ask you about debt instruments in India, what are the options available? And if you were to advise, at some point, including debt funds into your portfolio, how would you do that, given that age is a factor when you talk about the equity debt mix?
Yeah, I think for short-term goals, that is 1 to 2 year goals, I think you will have to go with debt instruments only, mainly with debt instruments, at least 80% into debt instruments. For medium-term goals, obviously, depending on the risk appetite and what is our goal, we have to do a proper asset allocation. Debt mutual funds, I think, will score about bank FDs and other things, because that will give you, number one, liquidity, number two, additional tax benefits. Also, it will give you time to ride the interest rate curve. So when you are investing in a falling interest rate environment, actually you will be able to get good amount of capital gains along with the coupon on that. So debt mutual funds, I think, would be the preferred option to invest in fixed income securities as compared to bank fixed deposits or another company fixed deposits.
Thank you, Mr. Irani. On that note, it's time to slip into a quick break right here on NSE Finviz, but stay tuned. A lot more to discuss on personal finance on the other side. Welcome back in conversation with Mehrab Irani and Pankaj Matpal here at NALCO in Angul. And let me throw the spotlight directly onto the core topic, which of course is insurance. Before we move in, we did see a lot of hands be raised when they asked, when we asked them, are they invested in the insurance sector? My first question to you, is insurance saving or investment at all?
I don't think insurance is investments. I think both are totally separate. Insurance companies, if you see after the expenses and the fund management charges which they give, is actually very, very bad returns. There are two kind of insurance policies which you can take on a personal basis. One is a pure insurance policy, which is a term policy, and the another is investment related policies. Those are like endowment policies, money back policies, ULIPs, etc. So I'll give you a very simple example. Say there is a 25-year-old person, he is taking an insurance policy of say 1 crore rupees. Then the premium of that is, if you take a pure term policy for 30 years, the premium of that would be close to between 8,000 to 9,000 rupees, depending on which insurance company you take, whether you take online or offline. So that is the first option which he has. The second option is he can go for an investment come insurance policy, say a money back policy. On that, the premium for it will come close to 1,13,000 per annum for 30-year period. So over a 30-year period, he has paid 33,90,000 rupees as premium. Instead of that, if he had just taken a term policy, he would have saved 1,04,000. That is 1,13,000 minus 9,000, 1,04,000 plus annum. If that 1,04,000 he had created a proper portfolio of his own asset allocation, investment in stocks, bonds, etc., he could have generated anywhere between 10 to 12% return. Assuming a 10.5% return on that over 30-year period generates a corpus of 2 crore rupees. So in the first one, he has only 1 crore rupees after 30 years. In the second one, he has 2 crore rupees. And the insurance cover of 1 crore rupees remains intact. So I always think that investments and insurance are both separate. You should take pure term policy, and investments you should do in a proper asset allocation, what as per your age and requirement.
Mr. Matpal, when you do talk about term policy, A, do you echo the sentiment that Mr. Irani just mentioned? And B, the Indian thought process is that if I invest into something, I need to get something back, which may not be the case in a term policy. Having said that, what would you recommend?
See, key objective of life insurance is to protect future income in case of untimely death of the breadwinner. So if your family members are financially dependent on you, then only you need to buy life insurance. When you buy life insurance, you have two choices. One is term insurance, which is pure insurance. Second is combination. But because in combination, the returns what you get is very too less. So why don't you buy a term insurance, which is pure insurance, though you won't get return. Means if a person dies, then only family members, they get claim, which we don't expect that person who buys, he should die and get returns. So let it go waste. But the good thing is that your premium is very less. When you buy a policy which is saving and insurance, your premium is very high. Now what happens when you pay higher premium, out of that also a big portion goes towards mortality charges. Means like you are paying some premium for a term insurance, similarly from your saving and investment policy, your insurance and saving policy, from that also big portion goes towards mortality charges.
Sure.
So returns what you get only on the investable premium. So though you may feel that you are paying 50,000 rupees towards premium, but what returns you are getting, that is only on the amount after adjusting those mortality charges.
Sure.
So if you are getting returns only on the investable premium, then why don't you invest in term policy, and that rest what is going towards investment, that you invest separately in some other instruments which has potential to generate higher returns.
Multiply your money. Fair enough. Now if I can have Mohammad Qasim from the HRD and admin department here. A very interesting question. Remember here, Mr. Irani, that he is 59 years of age. What are the deciding factors to buy health insurance at 65 and life insurance after 60?
I think generally nowadays there are options of getting insurance up to 65, 70, even 80 years of age. But what I would feel is that generally life insurance should be up to your retirement age, because by that time your investment corpus should be at such level which should take care of your retirement. Plus also a lot of your needs are already fulfilled, hopefully by the time you are retired. That is your children's education, children's marriage, housing loan, etc. So now you are only caring about your retirement. So if the investment corpus is done properly during the earning stage, then I think after retirement there is no need for real pure life insurance because the investment will take care of this. As far as medical is concerned, I think medical is very, very important, particularly with increasing age. The chances of medical expenses increasing along with high inflation in the sector, I think it's very, very important. But at this stage, what options you have, I think you have to evaluate it, because the premium obviously will be slightly higher side at this age. So you have to evaluate the options and see it properly.
All right, the A to Z of health and life insurance, but it's time for a quick breather right here on NSE Finviz. Stay tuned. It's Personal Finance Rapid Fire Q&A on the other side. It's a pleasure having you back here on NSE Finviz, and it's time to throw the spotlight onto the audience here at NALCO in Angul. Can I have a show of hands, and any personal finance queries, we'll have the microphone to you. The gentleman in green first, please.
Good afternoon, sir. My question is regarding children's education fund. I have a kid which is who is about 2.5 years, like 3 years, about to get 3 years in March. So I'm really worried about the education cost, especially the higher education, which is gradually very escalating. I think if my knowledge goes right, it is even more than the inflation rate, I guess.
Child education plan is a long-term plan. You have sufficient time to grow your wealth. First thing, do not invest in child insurance policy, because that will not serve the purpose in some ways, because life cover, that is also limited, and there is not much scope of creating wealth through these life insurance policies. The easy way is that first you calculate the future value of the cost. If suppose what you said, that today cost of such education, what you are thinking about your child's education. So whatever the present cost, considering around 10% inflation, calculate what will be the future cost when your child take that kind of education. Then invest in equity mutual fund through SIP route. Why equity? Because considering the time horizon, in long term, equity is the best asset class to create wealth. So invest in diversified equity mutual fund through SIP route and keep increasing your investment year after year, because as your income will grow, at the same time you should increase your SIP amount. So if you want to accumulate, say 50 lakh rupees after 10 years or whatever amount comes, and you want to start with 5,000 rupees, 7,000 rupees, whatever possible today, increase it year after year so that you can achieve your goal.
My question is on pension scheme. I found that annuity returns are less than investing in some other funds. Secondly, if annuity I will purchase, then there are so many schemes in the annuity. Which one will be better for us to purchase? Thank you.
Yeah. Again, going back to the same thing, I think we should not combine investment with insurance. So you do your normal insurance, and I think you should more invest in a diversified equity schemes. I think that would over longer term create much more wealth for you. If you see last 20 years, lot of the equity funds have given between 18 to 20% compounded return over a very long period of 20 years. So when you are talking about your retirement, I think your majority of your investment should go into diversified equity schemes, which will give you the best kind of risk adjusted returns after tax also, because they all become long term, and long term is tax free also. So I think that would be the best option for you to do rather than considering other things. And insurance obviously is separate. You have to take a pure term policy for that.
And on that note, we're absolutely timed out on this edition of NSE Finviz. Mr. Matpal, Mr. Irani, thank you so much for joining us here. From all of us here at NALCO in Angul and the entire team that put this show together, thanks for watching and have a great weekend.
Focus. Ideal. Innovate. Enable.